Assalamu alaikum friends, welcome to Test Your Understanding 6. This is your sixth question from your SBR textbook, the last chapter question and answer. And let us read the requirement. So this requirement is also very similar to the previous requirement. You have to discuss the correct accounting treatment under each of the transactions and for 25 marks. And the marks are given. There are 4 different issues that you have to say the correct treatment. And let's start with A. So before A, let's see the background of this. This is about a coffee. So coffee is a company and they have a reporting date 30th September 2004, and this 30th September 2004 is applicable to all the 4 parts. Okay. Its financial statements are prepared in accordance with IFRS, and there are a number of unresolved accounting issues. So let's see. The financial control of coffee was appointed during the current reporting period. She is concerned that some of the payments made this year significantly larger than the amounts that were provided and accrued for. The 2 largest discrepancies are detailed below. Okay. If you see, part is for 7 marks. This 7 marks you have to allocate accordingly with the 2 issues, the 2 discrepancies. First one is legal expert had previously advised Coffee that it would probably be found not liable in a court case concerning breaches in employee health and safety legislation. Not liable according for the health and the safety legislation. Okay. As such, a contingent liability was disclosed in the financial statements for the period ended 30th September 2003. However, on 1st of July 2004, Coffee was found liable and was ordered to pay damages of 2 million. Okay. Now, so this is regarding it. Now, the second one is in its financial statements for the year ended 30th September 2003, they provided for income tax payable of 3 million. First one is about contingent liability. Okay, you can say more like a provision. Second item is about income tax. So the income tax payable of 3 million. However, in January 2004, their records were inspected by the tax authorities and a number of errors were discovered. Let's see what are the errors. Tax authorities recommended that Coffee improves its control and training to prevent such mistakes from happening again. Coffee was not levied with any fines, but the authorities deemed that the correct amount of tax payable on profits earned in the period ended 30 September 2003 was 4 million. This is the tax payable, the correct amount of tax payable. But they have recognized 3 million, right? Coffee paid this in July 2004. Coffee requires evidence as to the correct accounting treatment of this 2 event. Before we go to B, with the information given and that we have read, you can answer a party. Right? First one is regarding the standard. It is IS 8. Why? Because earlier you have recognized a contingent liability. Later, because you were told that you will not be liable for breaches regarding for health and safety of your employee. Later, on July, you became liable. So that means there is a change in. It's an error, right? An error had happened. So errors are dealt under IS 8. Accounting policies, changes in accounting estimates, and error. Okay, it could be policy, it could be estimate, it could be error. Out of these 3, if any of these 3 things occurs, it will be dealt under IS 8. Hence, this first one will be dealt under IS 8, right? Even regarding tax also, you have wrote 3, but it was 4. Okay, so this is, you have to identify, by the way, out of this 3, whether it's a policy, whether it's an estimate, or whether it's an error. Okay, so say it's at a prior period error. This is an error. That means prior means earlier year, you have in the earlier period you have made an error. Now you have to correct that error, right? Says that a prior period error is a misstatement in a prior period financial statements resulting from misuse of information. So this you have to take into account. Now, so prior period error, you have to adjust retrospectively. Retrospectively means go back and change it. You have to go back and change it. That means you have to restate again the comparative amount. If there is a change in accounting estimate, prospectively. Estimates like changes in depreciation rate, or this will be prospectively, means you will not go back and change in the past, you will present change that just the current and the future figure by including the impending profit and loss in the current period and where relevant future period also. Okay, so its impact will be included in profit and loss in the current period, and where it is relevant in the future period also, you can show the impact. You can change the profit and loss of the future also if it's given to you. Now there are 2 things, one is court case, one is tax. It's for 7 marks. You have to deal with these 2 things separately. Let us first deal with the court case. What is a court case? Is it an estimate? Is it an error? Is it a policy? What is it? This is not a prior period error. You cannot say court case is an error. Okay? You are just estimating. So this will be not, it's not a prior period error. Because coffee has based its accounting statement on the best available information. What is it? Because the lawyer had told them that they are not likely to be found liable. Right? That's the best available information you have got. So based on that, you cannot say it's a prior period error. So the payment of this 2 million. Remember they told that 2 million has to be paid. This will be expensed to profit and loss in the current year. At this, it will be expensed. Because it's an accounting estimate. It's just a changes in your accounting estimate that change. It's not an error. It's a change in accounting estimate, this court case. That's why you are expensing it currently in the profit and loss. You don't have to change it retrospectively. You have to change it prospectively, estimates. That will change the current and the future periods. Right? So no need to correct the contingent liability that you have disclosed earlier. Just recognize 2 million as an expense. 2 million that you have to pay for the damages. Now coming to the second, which is tax. Remember, you have to use a subheading also. You're dealing with different issues like this. So the mistakes, this is a mistake that you have made, right? So the mistakes that you have made in the financial statements, this should have not been made. Okay, you should have not made this mistake based on the information that is given to you, the coffee. So this therefore satisfies the definition of what? It's a prior period error. So how are you going to correct this? On 30th September 2003, the current tax expense, you have to increase it by 1 million. Currently, you have recognized it 3 million, but the correct amount is 4 million. So increase it by 1 million, the current tax expense. And both the income tax payable, both have to be increased by 1 million. Okay, now we are coming to part B. Because why we told that it's an error? Because see, tax and all, there are very less chances or you cannot defend saying that you have made an error in the tax. You cannot, because you have all the information. But when you have to see something for the future, tax is based on something past. You have to document everything, the tax rate, you just have to calculate it, right? But for court cases and all, you don't know the decision. It is something to do in the future, something you are uncertain today, something to do with probability. So there, it's more likely to be an estimate that you're making. It's less likely to be an error, right? So that's the reason the nature is different of these two things. Coming to part B. Coffee makes a number of loans to its customer. Okay. The interest rate on this loan is at a market rate. Within the first 12 months, Coffee sells this loan assets to another company called T. Okay, so T, which is a subsidiary of Coffee, holds the loans until maturity. At the period end, Coffee hold loan assets that it has yet to sell to T. Okay, Coffee holds that has yet to sell, and Coffee wishes to know the accounting treatment of this loan assets in both its individual as well as its group financial statements. Why? Because they are doing it to the subsidiary. This is very important from your group accounting point of view. It might be asked even in your question number 1 for 30 marks. So you have to be very careful. What is this type of nature? What is it? It's a financial instrument. It is a financial instrument according to IFRS 9. Right? Whenever you are giving a loan to someone, loan asset, remember, it's an investment in debt. The moment you see loan, it's an investment in debt. You should be careful whether it's an investment in equity or a debt. Then the treatment will change. So this is an investment in debt. It's an asset, but it's an investment in debt. Through debt, you are holding an asset. Your asset is a debt. Through that debt, you are receiving cash. Okay, and since you are holding it until the maturity, that is your business model, you shall held this at amortized cost. Remember, there are three methods: fair value fair value at profit and loss, fair value through other comprehensive income, amortized cost. This one, since you are holding it until maturity, not selling their debt, the loan in between, then you shall held this loan asset at amortized cost. Okay, because business model is to hold until maturity. This is some keywords that has to be there. So the contractual cash flow characteristic tax is past. It's past. You're holding it. And the contractual terms of the financial asset give rise to a specific in which cash flow that are sold payment. And also the cash flow that you're going to receive has to be solely the principal and the interest on that principal amount. Okay, if it's these two things are there, and if and the cash flow characteristic test is passed, that means you have a contractual right to receive a cash from financial asset on some specified date, then it's a financial instrument. It's an investment in debt, right? So first you have to tell the rules, state the rules from IFRS 9 before you bring this into the case study for individual and consolidated financial statements. Okay. But what if the business model is to hold the asset to maturity and then sell the asset? That means you're selling that loan because your asset is that loan, which is an investment in debt. Then debt instrument should be measured at fair value through other comprehensive income. Then you cannot tell it at amortized cost because you're selling it. Okay. And other than this, all the other investments in debt instruments should be measured at fair value through profit and loss. I told you the three measurement: amortized cost, measure fair value through profit and loss, fair value through other comprehensive income. Now we are coming to this. One is in the individual financial statements, one is in the consolidated financial statements. You have to know the impact in both the places. But most of the time in your question number 1 for 30 marks, what comes is your consolidated financial statements. Very rarely they might give you individual financial statement also. So you have to be prepared for that as well, because you never know what comes up. So if individual means in the coffee is individual financial, how is he going to recognize this financial assets? So coffee regularly sells the financial assets and therefore does not hold them in order to collect the contractual cash flow. That means he regularly sells it. He's not having holding it to collect contractual cash flow. Contractual cash flow means the interest and the principal amount, right? So because of this, in their individual financial statements, how are you going to measure the financial assets out of the three methods? Can you measure it at amortized cost? No, because you're not selling it until mature, holding it until maturity. Fair value through other comprehensive income? No. It is fair value through profit and loss. Financial assets should be measured at fair value at the reporting date with any gain on losses reported in profit and loss. Okay? Because you are regularly selling it. You are not holding it until the maturity and then selling it. Then it will be other comprehensive income. Here, you are selling regularly. So they told before only all other, then the two conditions given to you will be through profit and loss. Now we are coming to the consolidated financial statements. If you want, again we'll go through part B. So within the first 12 months, they sell this loan assets to another company called D. They're making number of loans to customers and they're selling it to the other company D also. Okay. Now we are coming to the consolidated. Which standard you're going to refer to? IFRS 10. Okay. So what does I say the rule from IFRS 10 first in the first paragraph? Okay. So when you are writing, showing the group accounts, show the income, expense, asset, liabilities of the parent and a subsidiary. When you are showing the income, that income is of both the parent and subsidiary. Same for expenses, assets, and liabilities. You are adding both parents and the subsidiaries, and they will be in one financial statements. Single economic entity. It will be treated as like that. Okay. So any profit or loss that are arising on the sale of the assets between coffee and tea, this will be eliminated because they are same group. They are under the one group only. They are not selling it external outside the group. It's internal only. From here to here, it's just that from subsidiary is going to parent or from parent is coming to subsidiary. It's the same thing. So it has to be eliminated. You cannot recognize any profit or loss if there is any transaction that happens between parent and subsidiary or the subsidiary and the parent. Right? So eliminate it when you're producing consolidated financial statement. Second, para says we are relating this to the tea and the coffee. So tea holds the financial assets until maturity, the subsidiary. So therefore, the financial assets are held. This financial assets will be held within the coffee group. Coffee is the parent. Okay, because if the subsidiary is holding the financial asset, the loan, until the maturity means group will be receiving that until maturity. So he will recognize that financial asset. He will be collecting the cash flow, the interest and the amount of the loan. So in the consolidated financial statement, this financial asset should be measured at amortized cost because subsidiary is holding it. They are receiving it till the maturity date, the coffee group. So amortized cost. Now, assuming that the credit risk, you have to talk about the credit risk also, whether it's going to be high or low, because you have talked about investment in debt. This credit risk all comes for investment in debt. It will not come for investment in equity or anything, right? So if there is any credit risk, that means maybe your customer will not be able to pay you the amount of the loan back or the interest. So assuming that the credit risk is low at the reporting date, a loss allowance must be created equal to 12-month expected credit losses. Okay. So group could designate the financial asset to be measured at fair value. They can say, okay, the financial asset to be measured at fair value through profit and loss. They can designate this, the group. Okay. If it reduces an accounting mismatch that arises from recognizing gain and losses on different bases. For example, your gains are in profit and loss. So you can also say that financial asset, you will say that it's better to recognize the financial assets measured at fair value through profit and loss, because the gain are recognized in profit and loss. If it's in the same place, there will not be an accounting mismatch. So because of that logic, you can say, okay, let's designate fair value through fair value through profit and loss, right? So in this condition, yes, the group, this is a group we are talking about. The group can do this. They can say, okay, even if it's at amortized cost, they can say we'll measure the financial asset through fair value through profit and loss, sorry. Now we are going to see, and I think I have 10 parts just for IFRS 9, so you can go and check there in my SBR lectures there. In the beginning lecture, you will see. Just in this, everything, all this will go in the same playlist only, right? And the playlist is in orders. It will start with conceptual framework, then ethics, and then the others, and then I think IS1. So go by this, you will get all the lectures there. Now part C. At the end of the reporting period, Coffee bought 200 kg of gold bullion for 4 million in cash. Gold bullion is traded on an active market and can be bought and sold instantly. The fair value of gold bullion changes very drastically, right? Coffee made the investment with the intention of trading it at a profit in the short term. Coffee is unsure whether the 4 million holding of gold bullion should be classified as cash or cash equivalent. Okay, so let's see. For this, which standard you should know, even though they didn't specify the standard, just because they told whether cash or cash equivalent, IS7, remember. Because IS7 will define cash and cash equivalent. So C is about that. Okay, it's very short. Because they define cash and cash equivalent one. What is the definition of cash equivalent? Something which is short term, highly liquid investment. That means easily you can change to cash. Okay, that are readily convertible to know. Easily you can change it to a known amount of cash. Okay. Okay, and there is an insignificant risk of change in value. If the value changes, it's very insignificant risk. Risk is not very significant. If these conditions are met, you can say it's cash equivalent. So in this case, let's see whether gold bullion is a cash equivalent or not. Okay. So this is held for what investment purpose? Okay. So because it is held for investment purpose means it is not for the purpose of meeting short-term cash commitment. No. You cannot say for how long you are holding investment purpose. Maybe it can be for long term. So because it's for long term, it does not meet the definition of short term. There is also a substantial risk, even the risk is substantial. Why? Because the gold will go up or down in value drastically. So because the value keeps going up and down, you don't know what is the known amount of cash, the convertible amount of cash. So in this case, this gold bullion has to be excluded from cash as well as cash equivalent in the statement of cash flow. You cannot put it as cash also, cash equivalent also. Then what about the money spent on the gold bullion? How are you going to present it? Cash flow from investing activity, because you're holding it for investment purposes, right? Part D, the last event for 5 marks. On 1st October 2003, he spent 2 million on acquiring a customer list that would probably provide benefits to the business for 18 months. That means 1 year and 6 months. Coffee has used his own knowledge and expertise to enhance the customer list. It believes that this enhanced list will bring its benefits indefinitely, and the directors estimate that at the reporting date, the original list has a fair value of approximately 1.5 million. And the enhanced list has a fair value of approximately 5 million. You have to advise them the correct accounting treatment. What is a customer list, by the way? If you don't know what is customer list, you are going to face problem here, right? See, if you there's a hint, okay? I will give you an advice here. In case if there are some terms, some word that is given to you in your exam and you don't know what is it, maybe that word is new, maybe you have never heard of, maybe you went through it but you forgot, because these words are not very common, you keep forgetting, right? Customer list and all those things. So what I would suggest is, don't waste your time thinking too hard if nothing is coming in your mind, or rather than wasting your time writing incorrect stuff, what I would suggest is leave that question, that time, okay? You can save that time, leave it and go to the next question, okay? At the end, keep some time so that you can come at the end and do that question, okay? Maybe at the end when you come to do that question, after you finish all the paper, sorry, all the questions, you will be in a better situation to answer it. Why? Because first of all, there is no stress on you, because you have finished all the questions. Now you have ample amount of time to answer this question, and you can think also, okay? So that time, whatever comes, just keep writing, okay? But don't leave it blank, okay? So that's an advice. D. So it's an intangible asset. If you don't know what is it, it's an intangible asset. Customer lease, brand, copyright, all this thing comes under intangible asset. If you don't know, okay, because this gives value to a company, so it's an intangible asset. And intangible assets, initially you measure it at cost, okay? So initially it will be at 2 million, which is at cost. Now, just wait a minute, is it at, because you have spent 2 million on acquiring this 2 million fair value, they have given 1.5 and 5 later. So but initially at 2 million. Now, expenditure on internally generated intangible asset. Remember, if you are internally generating that intangible asset, for example, you have stayed in a business for 5 years, and during that 5 years you have built up a brand. Now that brand is very valuable in the market, but you have built it over a time. It is known as internally generated brand. You cannot you know you cannot recognize it in the financial statement at cost. How you recognize the purchased intangible asset? When you're purchasing the brand, someone else's brand, then yes, initially you measure it at cost. Not all intangible asset, only purchase intangible assets you measure it at cost, because this is the amount at which I bought this. The cost reliable, you can estimate, right? But what about the internally generated? How can you put a value or a cost for your own brand that you have generated over a time? So, except those arising from development activity, this cannot be distinguished from the cost of developing the business as a whole. You cannot say that from the cost that I have developed the business, this is the cost of my internally generated intangibles. Sorry, my brand or my customer list. You cannot distinguish. You cannot differentiate that this will be the cost for my customer list. No, unless it's a development cost. Development cost, yes, but other than this, you cannot. So such items you cannot recognize also as an intangible asset. So you have to see the enhancement, whether it's an internally generated or purchase. Enhancement is something which is internally generated. So enhancement to the list is internally generated. So you cannot recognize it. End of the story. Full stop. But intangible assets can only be held under revaluation. So intangible assets that you can held at cost, that you can held under revaluation model only if an active market exists. If no active market, then at cost also. Then later also it will be at cost. So customer list is a bespoke. That means it's very customized nature. From entity to entity, it will be different, right? So no active market will exist. Active market cannot exist for customer list, which is a bespoke, right? Active market stays for those items which is very common, brought to everyone. Everyone can use it. It's whether entity A uses it, entity B uses it. The value will be same. The fair value will be same for that asset. But customer list is something very, customer list is different from entity to entity. Your customer cannot be customer, another entity's customer, right? Maybe it is sometimes very common, but not necessarily it will be, right? Majority of it will be different. So customer list is customized. For customized product, it's very hard to find active market. So therefore, it cannot be held at fair value. Okay. What about amortization? Remember, intangible asset comes means amortization also will come. So customer list should be amortized over its estimated useful life of 18 months. Yes. You have to measure that cost, number one. Number two, amortize it over its estimated useful life of 18 months. Because they told 18 months they are going to receive the benefit out of it. So amortize it also over 18 months. Why? Because this is the period over which the benefits of this 2 million expenditure will be realized. Cost was 2 million, out of it 18 months you will be getting the benefits. Amortize it. So divide this 2 million by 18 months. Okay. So what will be the amortization expense that will go in the profit and loss in the current period? 1.3 million. How? 2 million into 12 divided by 18. Usually what happens is we do something, let's say 6 months, it will be 6 over 12. This time, because it is denominator will become 18 out of 18 months. Okay, this will be 12 whole day. This will keep increasing, right? So 2 into 12 divided by 18. Okay, it's not 2 into 18 divided by 12. Come on, how can 18 be, this has to be less. Your numerator has to be less, right? It is out 18 months you are going to get the benefit. So 2 into 12 divided by 18. This will be the amortization expense. And what would be the carrying amount at the reporting date for the intangible? Reporting date means the closing date. At the closing date, where do you recognize intangible? Statement of financial position, right? Just deduct your amortization from the carrying amount. Carrying amount is 2 million, that is your cost. Amortization is 1.3, so carrying amount is 0.7 million, that's it. So it's as simple as that, right? What is so hard about it? So it's very simple. So now, what is this? This is test understanding 6. We just have 2 more questions, and before we finish this SBR, it falls under SBR lecture. You can say it's SBR, the questions, right? After the lectures. So see you in the next 2 questions. Till then, take care.